Hey David, this is Jacob. Just wanted to give you a quick overview on what we discussed this morning in terms of the consolidation analysis and what's required to complete that report. So obviously you want to start in your client screen because you got to make sure you have all the appropriate information in there first. First things first, this top area is just an address, so you've got to make sure it's also represented as a property down below. If you don't see it down here, hit the Create Primary Residence button and then Save and Close, and it will appear down on the list down here. You can ignore the TBD property for now. We're not going to focus on that one. But what we're going to do is show a refi through that debt consolidation analysis of this particular property and the mortgages tied to it, along with any debts that you'd like to include. So that said, we need to make sure we have the mortgages and the debts entered. To manually enter them, you can click on the Mortgage tab here. Let me zoom in for you. You can click on the Mortgage tab here, then hit the Add button. This opens up a new screen that allows you to put all the details in on your main mortgage here. And I've already got one in there as the first TD, so I'll put this one in as a second. Let's say that this one was for, I don't know, $30,000. And let's say that this one was a HELOC at 8%. And we'll see they took it out at the same time as the other loan. Since it's a HELOC, we want to make sure and make it interest only. So I've checked the interest only box and I've specified a recast month of 121. You can actually use the last month of the term because a HELOC is IO for the entire thing. But once you tab off of that start date field, you'll see it updates your estimated balance. And if you hit copy to current, it'll put in your monthly payment for you and it'll copy your current loan amount up to the top. So that's how you input the mortgages. Now for liabilities, click on the Liability tab here, and you can add liabilities using this Add button. And I already had that student loan in there from the call this morning, but I'll add another one. Let's do a revolving debt. And let's say they got $5,000 on this one, and their rate is 10%. And if you want to, you can do a minimum payment. I'll just do a fixed payment for this one of $200. And then Save and Close. And now we've got two debts in there. Now that we've got our debts and our mortgages established, it's time to go over to the Analytics screen. So what we'll do, click on Analytics, and then if it's not already on the Consolidation Manager, go ahead and click on Consolidation Analysis. That's going to open up this screen here. Now the important part of this report is that you'll notice it'll display all your debts, mortgages, and liabilities right here in the Current Liability section. And you'll need to tell Analyze how you'd like to pay them off. So in this case, let's say that we're going to refi both mortgage debts, so we're going to pay them both off, and then we're going to pay off the entire credit card. But let's say we only want to pay off either a portion of the student loan, or we want to use the savings from our monthly savings from our P&I payment. If we want to use that savings to pay off this particular student loan, we can choose Pay Off with Savings. So now what this has done is we can now see on the far right side here, current debt structure, the ones to be paid off are the two mortgages and the revolving debt, and this is that $5,000 credit card. And you can see that it shows a blended rate of all assets, shows a total balance of the payoff, and it shows our payment, our total payment of $1,596. It shows our total tax deduction as well. Now since we're going to need to pay this off, we need to come up with something that's at least $229. So our new loan is going to, let's call it $230. So what we'll do is for our new loan program, we'll just name it whatever you'd like to call it a 30 fixed. You're going to enter your loan amount. Our payoff is $229, so I'll put $230. And let's say that this is going to be a new fixed loan, and the interest rate on this is going to be 5 1/8. We have about $4,000 worth of closing costs, and we're not going to charge any points on this one. Now as you scroll down the list here on the left hand side, the next section you want to do is actually the bottom section, the taxes and insurance. And you can do that by manually entering the figures here, or you can use factor percentages. I like to use factor percentages myself, but you can use the manual numbers if you'd like. And you'll see it generates a total PITI payment for you down here of $1,609. Now when we're comparing our current debt structure, giving us a $1,596 payment, versus our recommended debt structure giving us a $1,252 payment, even after tax deduction, we're still showing a $344 savings. So not only are we paying off the loans, but we're showing a significant savings on the P&I payment. So we want to reinvest this savings. Now, since we're paying off this student loan, it's a 20 grand loan, we can't pay it all off because we can't take enough out. We're going to exceed our equity. So what we want to do is we want to pay off a portion of this with the proceeds from the savings. This $344, if we want to redirect it back into that student loan every month, what we would do is go to the savings allocation, and then you want to click on consumer debt allocation. And we've only got one loan that we've tagged to pay off with the savings. So what we're going to do is we're already paying $400 on this. We're saving our client an extra $344. So let's say we wanted to address that $344 payment and put it straight back into that student loan every month. Now you can see that it's now going to show our remaining consumer debt. It's going to show our payment of $344 and our new payoff time of 3.42 years. You can see just from doing that, we're saving the client $2,300 in interest on this particular debt. Now, if you wanted to do other strategies, for instance, you wanted to break up that $344, you don't have to assign it all to paying off that debt. So, for instance, I could go back to my consumer debt allocation, change my prepayment here. I've got $344 to work with. Let's say I wanted to put $100 of that every month into the student loan, which would mean I still have $244 to work with. Let's put it in an asset accumulation account so they can see what that extra $244 is going to do in a growth account like a CD or a money market. Now, to do that, under the same savings allocation section, we've already selected accumulation. Let's say they can get a 3% yield rate on a CD. We're going to take that extra $244 and we're going to reapply it. So you can see down here at the bottom right, our asset accumulation is now showing that we're reapplying this $244 cost savings into a liquid asset, and at 5 years we'll have $16,000. At 10 years we'll have about $34,000, and at 15 years we'll have about $55,000. So this is a liquid asset that we're developing here. So not only have we saved the money on their P&I payment, but we're reinvesting the cost savings into both an asset accumulation, developing a liquid asset for them, and paying off this $20,000 debt in small increments here. So we're just applying an extra $100 to their payment on that. That's the skinny on it. That's all you need to do with this. There's not a whole lot to it. You may find that if you're doing a cash out refi where the person is actually going to retain a large chunk of the money from the cash out, you might actually want to put that cash out amount in the opening balance section up here so they can see a growth on that cash out. But that's about it. I'm going to head out for the day. Feel free to email me if you have any questions, but have a wonderful day and we'll talk soon. Thank you.